You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
This time, let's blame it on the rain. I say we blame it on the rain. Hi, welcome to Talking Real Money. I'm Don McDonald, along with a waterlogged Tom Cock, whose equipment is not doing what it's supposed to do, in that it's supposed to magically connect. And for some reason, it's not magically connecting. So we're going old school. He's got the tin can, the string. We've run that across Lake Washington all the way to the Como studios. And let's see what the quality of Tom's string is like.
I pulled it very taut. I hope this will work.
Yeah, it's actually better than I thought. Last time we used the string, it was, it just sounded like somebody whistling.
I could do that too, by the way.
Hey, everybody. Welcome to Talking Real Money. We're here to talk about money. Now, Tom probably won't stay with us for the whole show because, it just doesn't feel like being a regular radio host when you're on a phone, right? Plus, there's a delay. The delay's really bad.
It is. I can see you saying things and I hear you about 4 minutes later. So,
yeah, that's really weird because I don't understand all this stuff. I wish I could afford someone full time who just sat around and was I'm pretty good at the basics of technology, but the deep dives into DNS and IPs and all those things, yeah, it's where my head starts to spin. And so we've got one tie line that's working. That's at my end. The other one at Tom's end is not seeing me for some reason. So on Monday, we're going to call the folks at tie line and say, please fix this.
Actually, if you're in the neighborhood right now, if you don't mind dropping by, see if you could fix it now, that'd be terrific.
Oh, yeah. Well, although I worry about the rain. Is it still raining?
The rains have subsided and we're headed for a period of very nice, dry, warm, sunny weather, I'm told.
Oh, okay. Because, Ben, yesterday when you called me from your car.
Yeah, that was horrible. Unlike the stock market, which is apparently headed for a great pullback of some kind due to either the COVID, the election, or some other matter, because I'm getting those questions from people a lot about, well, the election's coming up. I should move to cash or I should do something, right?
Yeah, no. Don't need to do anything. As a matter of fact, I went to that Dimensional conference this week, and they had a great presentation on presidential elections and stock markets that I'm going to talk a little bit about in a minute. Yeah,
which is fabulous. And just to remind us all that if you're feeling that way, you're not alone, because there was another write-up in the Seattle Times today from an airline pilot who handles the finances for his family, and he said, the last few years, I've been concerned about the stock market. I've been pulling back his portfolio 65% in stocks, 26% in bonds, and 9% in cash. He's 45 years old. 9% in cash, sitting around in cash, which is
the only reason you should have cash in your portfolio is for emergency purposes.
Exactly, and I mean, even there, I would try to do. And we've talked about this on the program before, Don. I would try to do a high yield savings account of some kind. We've sent you to Bankrate.com and other places where you can look up something at least decent. But those rates are shocking, gone down. So they were at like 2%. Now they're like 0.5%. So you're literally making absolutely nothing on the cash. And there's no reason to hold cash unless you're going to spend the money. And at 45, money in your IRA, it's unlikely you'll spend that for 20 years. So you should be invested the way to your risk tolerance and your attempt to make money in the markets, not mess around.
The problem is, though, and we see this constantly, we've seen it for decades, is emotions take control. Your emotions get the better of you, and there's no place for emotions when it comes to investing.
Indeed, that is correct.
Did you connect? It didn't. I'm not hearing anything. Oh, yeah. He said he got connected, but I'm not picking him. Are you hearing me over the tie line? That is weirdly, funkily weird. We are just having a technological field day today on Talking Real Money, which just goes to show this is live radio. 855-935-TALK is our phone number. We're going to fiddle with it during the break. 855-935-8255. If you have questions, they involve money, we'll try to get them answered.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's vestory.com, or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
All right, Tom's fixed his equipment.
Which isn't easy at this age. I'll tell you.
It gets harder all the time when you're getting up here. Hi, everybody. Welcome back. We got stuff fixed. Tom's on a actual tie line machine thingy, and we're talking real money at 855-935-TALK, 855-935-8255. It is what? Just 5 weeks till the presidential election or so, and
I wrote down the number of trading days, 25 trading days. So if you're going to do something with your money, you better hurry up and do it.
25 trading days.
Not a lot of days. Yeah, you got to hurry.
Yeah, but the fact of the matter is, we freak out about elections, though. We really do. People are truly pulling back. I'm just going to sit on the sideline and see what the election brings, they say. And they shouldn't be saying that.
No, we both took in a class from people that we trust, because he's pretty well-renowned economist. They went back and looked at the numbers, Don, and presidential election years, have been pretty good to people invest in stocks. Well, we're not saying anything about this year, because this could be the next year that's down, but isn't it 19 out of 23 presidential election years, the market ends up, correct?
Right. And here's the thing. We tend to forget this really important fact, is that the stock market tends to go up more than it goes down anyway. And you can go back to 1929, and really we don't have great records since before then. You go back to the election of Herbert Hoover, and from 1929 to 1932, the stock market really took a beating. It did. No doubt. Yet the next term, which was some guy named Franklin Delano Roosevelt, stock market was way up 30%. Then it was down his next term. Then it was up. For every successive president's term. Roosevelt, Truman, Eisenhower, Kennedy, Johnson, Nixon. Carter, Reagan, Bush, Clinton. And then for 2 Bush terms, the market was down, 2001 to 2008. Then up Obama, Trump. So if you're playing the odds, which is the more likely scenario? Stocks are going to rise over the next 4 years or fall over the next 4 years?
And if you're specifically worried about this year, 19 of 23 of those, as I said, presidential election years have been up. The 4 down ones, by the way, I mean, if you look at them, they're kind of logical. It was down in 32. Kind of makes sense, right? Middle of the Depression. Down in 1940s, we started a Second World War. Down in 2000 after the dot-com blow up. And then 2008, we had that little financial problem in 2008. So market was down. So you can blame it on the presidents, I guess, but probably other factors were larger than they were.
This, though, goes back to human nature and the way our brains work. We can solve complicated problems, but when it comes to things we really don't understand all that well, like the stock market, we think that that one person can actually impact it. And when you look back, it really wasn't any one person who did any one thing. As a matter of fact, it wasn't even a series of events related to that one person. It was other issues, and these issues all came as a surprise. No one saw them coming. No one saw them coming. And that's part of them. But they also talked about something really interesting at this DFA conference. That's why you get rewarded for investing in stocks. It's that uncertainty that provides you with the rewards.
And that's the fascinating part of all this, because people think I'm going to put money into stocks and it's sort of going to go up automatically. And every day and every month and every year, it doesn't. And you have to be prepared for that volatility. And again, what we've talked about this so many times, Don, your portfolio, your asset allocation, your relationship between the risky things and the less risky things is yours. It has nothing to do with everything else that's going on, because next year could be horrible. The next 5 years could be. And in fact, remember how many years Professor French said we need to really determine if this is all going to work in the long haul?
Oh, my gosh. Yeah, this was the most fascinating thing. Kenneth French, a professor at Dartmouth, these guys run numbers for fun. For fun. They like it. And so he looked at how long it would take. He calculated how long it would take to determine what the rate of return, the additional rate of return that stocks provide over safe money. And he said, if you think it's 3 years, you're wrong.
Nope.
5? No, not even close. 10? Oh, yeah, no. 15? 20? 50? What was the
Keep
number?
going.
Yeah. What do you think the number was, folks? What do you think?
Yeah, call us and give us your estimates.
It will take 400 years of data to give us a decent idea what the return for stocks should be. There's a moral there. You want to know? You can't know.
Unless you're going to do the freezing thing or whatever, that bring you back after
hibernation.
50 more years.
Hibernation. One of these days, though, we're going to get hibernation. I'm telling you, probably not in our lifetime.
You know what? As tired as I am at 62, there's no way I'm going to go 400. So good luck to you.
No, but think about how much rest you'd get if you could hibernate for a couple hundred years. What a nap that would be. Oh, it's 22:20. I'm feeling so much better now. Yeah. And then you'd look around and you go, I have no idea what any of these people are talking about or doing. I have no idea. Put me back in the 21st century.
Yeah, don't do that. But here's what you should do. You should ignore the pundits. You should ignore your churning gut that makes you, I got to do something. And you should have a plan that even if at 45 or 55 or 65 or 75 that says, here's how much risk I'm taking in my portfolio, here's what I'm trying to achieve, and the rest of it is noise, especially under 400 years, which still is a few years down the line. Because we only have like 92 years, right, or whatever it is right now.
We have 94 years of
go.
excellent stock market return data. So we can give you a reasonable, like 25% correct estimate of what stocks ought to yield over safe money. But it's going to be only about 25% accurate.
Yeah.
Leaves a lot of room for inaccuracy.
Yeah, that's silly.
So in other words, you're not going to get this right. And I don't know what it is about us, but we search for the simple answers. We want it to be easy. We want to know that somebody knows what's going to happen down the road. And I wish you luck. You're never going to know that. So you might as well just get over it. Listen to our dull, boring advice and then call and get some of that dull, boring advice and stop doing all the fancy schmancy stuff that's just kicking your derriere, and pick up the phone or punch the buttons or just speak it to Siri, 855-935-TALK.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics, that's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Your guides to a really great financial future. Tom and Don are talking real money.
And it is just as easy can be to give us a call at 855-935-TALK, 855-935-8255. And Tom, welcome to Talking Real Money.
Hey, Tom, how you doing?
Tom. I don't think he's...
Tom?
Oh, there's no Tom.
No,
he's gone.
He's gone.
All right. Well,
but I'll tell you who
came
is
back,
there.
He went away.
To keep things interesting.
Who's there? Sounds like a knock joke.
Well, yeah, it is actually kind of. What? How am I going to phrase this?
What is there?
What organizations?
Wait, knock, knock.
Who's there?
What organizations did something you're going to talk about?
Well, I'll tell you why. Because they manage a lot of money. They manage a lot of your money because they're trying to make money on your money so they can pay you later. We're talking about pension funds here. You know, the people that a lot of.
Oh, I thought we were talking about Wimpy from the Popeye cartoons.
Exactly. More appropriate.
Pay you Tuesday.
Because pensions right now, according to the latest figures, have, let's see, I think I have this right, about 46% of their portfolio in stocks. 46, less than half.
Wow. They're being very conservative.
Well,
why are they being so conservative?
They have some money in bonds. They have some
how much
money
do they have in bonds?
It doesn't give the number.
Oh, you're a lot of help. Okay. Where do they have? They have most of their money, though, in stocks. Do they have like private equity and that stupid stuff?
Yeah, exactly. A lot of money there. Yeah, like 15% of the money there. And growing all the time. Hedge funds, because hedge funds are going to make you rich. Mm-hmm. Private equity, because you don't even know what you own from what it's worth for years and years, unless they find a way to go to the public markets. Alternative real estate, all kinds of other stuff. But the point of the matter is they have underperformed again. Remember, their number is 7. That's what they're trying to make. They figure if they can make 7, they can fund future obligations.
Oh, that is their number?
That's their number. And they've averaged about half of that.
Wow.
And if you as an investor think you're going to trade your way, this is what this is. This is trading, right? This is moving from one type of equity asset to another, or one kind of asset to another. If you think you're going to trade your way to make a lot of money, and these people with billions and trillions of dollars do not do it, think again.
Yeah, nobody can pull this off.
Nobody can.
It's a totally unrealistic expectation. And to that end, a little later on in the show, I am so excited. I'm always excited this time of year. It's like it's like Christmas. It's like Christmas in September when the new SPIVA information comes out. SPIVA comes out
wait
twice
for Christmas
a year.
Morning. Yeah,
I wait for SPIVA, the SPIVA U.S. scorecard. SPIVA stands for S&P indexes versus active. So it's how have actively managed mutual funds performed against the various indexes. And the results are always fascinating, and they're pretty consistent year in and year out. As a matter of fact, let me just share with you a couple of them. Get this. And the funny thing is the longer you go, the worse they look.
Now, just let me explain quickly.
Yeah,
active is somebody that's buying and selling securities or sectors or moving in and out of stocks and bonds, that kind of thing, versus indexes, which own a group of stocks all the time.
Correct. Those are the ones that just buy the index and just hang in there. And the farther out you go, the fewer beat the market. As a matter of fact, for 1 year, amongst all domestic equity funds, versus the S&P Composite 1500, 67% of actively managed funds over 1 year failed to beat the index.
Sounds like 2 out of 3.
Over 5 years, though, it's 8 out of 10 failed to beat the index. After 10 years, it's 8.5 out of 10. And after 15 years, it's only about 10% of funds that have shown any outperformance over and above the market. What are your odds of finding those funds? It's pretty darn slim. 855-935-TALK is our phone number, 855-935-8255. Let's talk about your money.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
Reality radio for a really great future. We're talking real money.
You know, it's funny. Just think it during the break. Hosting a live radio show is a lot like investing. You never know what's going to go wrong, but something will. And when it does, you just kind of have to roll with the punches. You just keep plugging along. You don't just throw your hands up and give up. You keep going. Just what we've done. Now we got Tom hooked up properly. It's as if that first half hour didn't even happen, although it did, and we know it did. Now it's recorded permanently. It'll be a podcast next week, so everyone will know. We are completely ready now to help you at 855-935-TALK, aren't we, Tom?
Feels so much better to be hooked up properly. You have no idea.
And you look better hooked up properly, too.
Thank you.
You're welcome.
Thank you.
Hey, Michael,
Right out of the neck.
Are you there? You want to talk to us? Maybe something will go right?
Hey, there you That's perfect.
Oh, okay. The second half hour of the show is off to a confusing and frustrating start. So,
but there is some good news. There is some good news.
Really,
we lost Tom. We lost Michael.
Yeah.
But you, if you're out there and you have a question, you can call right now and get straight in.
You know, somebody actually just sent one in, literally just now, just like minutes ago. Sent a question. So we can take this one and save us from another disaster.
Complete annihilation.
As long as I can get my way through it.
Please.
Okay. This one is about asset allocation. I know you can handle this one, Tom. This is right up your alley.
First of all, what the heck is asset allocation?
It's allocating assets.
I know, but I mean, come on. Those are such
fine.
Inside baseball terminology, I think.
Go ahead.
Thank you. The playoffs are here. Asset allocation. Here's what I think it means.
Yeah.
How you're exposing your money to other securities.
Okay, the way your mind was going.
You're laughing. You didn't.
No. It's the way your mind was going earlier about the equipment and thing. And then you went, the way you're exposing your assets.
There's a delay there. Okay, so the idea here is every person, young, old, kind of old, getting older.
Like us.
I know.
Really old.
Should have a plan that says how much of your money is in riskier things like stocks, because stocks are riskier. They go up and down more depending on the election, depending on the COVID, all those other things. Versus how much are in bonds. A bond is an IOU. There should be the ones you own should be far less risky than stocks, although you can own risky bonds. You make that decision for your position in life. It has nothing to do with all those other things I just mentioned. That's asset allocation.
Somehow I think the question probably would have helped you explain that, but.
Okay. Go ahead. I'm not having a good day, so go ahead.
Would you like me to read the question to you?
Please do, now that I took way too long explaining asset allocation.
Yeah, you exposed your asset allocation.
Again.
855-935-TALK. Call us or send us a thing via the internet like this guy did. Okay, ready? I will get a pension at retirement of 60% of my salary. You're the last.
Good.
No one else is ever getting those.
Congratulations.
After 30 years of work. Oh, so he's kind of old like us. Oh, no, he's not that old. Holy cow. After 30 years of work and you're 46?
Wait a minute. How's that work?
Wow, he started at his job at 16. And he's going to retire in 10 more years, too. My question is what my asset allocation should be in my 457 plan. Oh, he's probably one of those child geniuses who started working for a university at 15 teaching or something. 457, that's a government thing.
Educational.
Currently, I'm 80-20 stocks bonds following Jack Bogle's recommendation of 80% U.S. and 20% international. I scored a 73 on your risk quiz. I don't know how much I'll need to withdraw from my 457 since I'm pretty sure I can live off my pension. Thank you for your time. Now it goes to Tom.
This is this argument about should I consider my pension a bond?
Yep, kind of.
Right, because it's a guarantee, right? Mm-hmm. I'm going to get a certain amount of income whenever I start it. You can. Mm-hmm. You could consider your Social Security a bond. Unless you read all the nonsense that's out there now about how it's going to go away or they're going to reduce your Social Security benefit. You can. That's fine. Here's the thing. Can you really handle an 80-20 portfolio when you're 65 years old?
I don't know. It depends on the risk quiz at the time.
Yeah. I mean, 73 suggests that maybe you should be a little less risky, but you're willing to take some ups and downs. The short answer is, yeah, sure, that makes sense to me.
Well, but I have a longer answer. Following in your footsteps.
Of course you do.
That will come after we take a break to share stuff that pays the bills at Como.
Tom and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
For your real life and real future, Tom and Don are talking real money.
Weather too.
Hello, and welcome back to a strange hour. A strange hour
one of those,
talking real
sometimes
money.
You just write things off and you just want to start over again.
Well,
it's gonna be like most people look back at 2020. Let's just
exactly
X a line through that one.
This is the episode of Talking Real Money that is 2020.
Yeah,
writ small,
abbreviated.
It sort of epitomizes the year. Looking back at 2020, it was a mess. This is a mess. 855-935-TALK. But
fix this.
But it's a fun mess. See, that's the thing. 855-935-8255. We had a question online. It was about allocation. Tom explained what asset allocation was in 13,000 words. And but the guy said 80-20 in stocks and bonds, and then 80-20 U.S. international based on
that's
John Bogle.
Incorrect.
Yeah. I wanted to address that because when we first started talking to John Bogle many, many years ago,
late 90s,
he was 100% S&P 500, right?
He was.
You should have nothing else. Well, I believe that we, along with others, had a hand in wearing him down and convincing him that a portion of your portfolio should be invested in international. So he threw us a bone with the 20. I believe that had he lived another decade, we would have probably gotten him to 60-40. I really do. Because it makes more sense to have your allocation closer to that of the market capitalization of the global market. That's all. That's what I wanted to add.
And I think I'm going to do one of my podcasts next weekend on this because it's such a hot topic all the time. It seems to come up regularly.
I know. And
the numbers bear out a balance between the U.S. and other markets.
There's no logic behind it. It's very arbitrary. Well, I live in the United States. So? Is the rest of the world not making money? We're the only ones? Don't think so. 855-935-TALK is our phone number. Bill's up next. Welcome to Talking Real Money, Bill.
Is he really? Bill, are you really there?
Good afternoon, gentlemen.
Hey.
I'm glad I got through. It sounds like you're having too much fun here this afternoon.
Can hardly stand it.
Exactly.
I've
teeth
got
cleaning coming soon.
A couple simple questions. My wife and I have about $160,000 that we obtained through a family member's house sale. And we'd like to invest a portion of that. We're setting aside some of that money to remodel our house, which we own. And I guess we're looking to invest, a portion of that, maybe $120,000 into the market. Would we be taxed on receiving this money, or what taxes would, I guess that'd be the first question. Would we have,
how did you get the money?
It's through a relative that passed away.
Okay, so it was an estate. It was part of an estate.
Inheritance.
It was an inheritance. There will not be any taxes on that. No.
There won't be.
No.
Okay.
No.
And
So
I guess
you can invest it however you see fit.
What would be the best way to invest that?
Well, I mean, so it sounds like there's a couple of objectives. One is you're keeping some money set aside for a remodel. I heard that correctly?
Right.
Okay. And then the other money is longer term for what? What's the purpose of the rest of the money?
For retirement.
Okay.
Are you
how many years until?
Yeah. Are you going to need to spend it in retirement right off the bat, or is it something that's just kind of going to be there in case you need it?
Well, I'm retired myself, and I have my investments. And then my wife is looking to get into the market for the first time. So, and she's still working. So we're just looking to make a smart long-term investment.
Yeah, and the smart long-term investment is to invest based on her tolerance for risk. You need to know that before we can tell you anything else, because without knowing that, it could be that she can only stand 20% of the money in stocks and 80% in fixed income. Could be that she's a 60-40 stocks to fixed income. We don't know, but that risk quiz will give you a very good idea as to what she can stand, because the key to successful investing is having a portfolio allocated it properly so that you don't panic when the stock market does scary things, which is what it does from time to time, and it's totally unpredictable. So I think that's very good advice. I think the first part I would just set aside in some sort of high yield savings account. You go to bankrate.com, look up the rates there. They're paying about 0.5% or something. Yeah.
A little better than having in your checking account. I'd set that money there. I think Don's exactly right. And then after taking the risk quiz and giving some thought to how much volatility she's willing to accept, you could use a 2-fund portfolio. We give this out regularly, the VT-WAX and the VBTLX, stocks and bonds.
Vanguard Total World Stock Index and the Vanguard Total Bond Market Index, or what those two funds are. Then you figure out what because actually when you take the risk quiz, we give you what kind of an allocation that should probably be. It's not absolute, but it's because nothing is absolute because we're talking about the future, but it's the best guess we can come up with. Thanks so much for calling, Bill. And Sam, you're next. Welcome to Talking Real Money.
Hi, and thank you very much for taking my call. My question today, I know you've answered this before, but I missed it last time. What is the exact difference between an ETF mutual fund and a regular mutual fund? If you would go to Vanguard and buy the ETF 500 and their index 500, what are the differences, please?
There are differences. They're relatively convoluted, at least in the terms of an ETF. A mutual fund is very, very simple. A mutual fund is simply a pool of everybody's money, and the management company goes out and buys the stocks or bonds or whatever it is to fill that portfolio based on the amount of money that's been given to them, and everybody shares it equally. It's a common pool. It's like everybody owns the same portfolio. That is a really straightforward investment. One of the reasons it is taking us and it has taken us so long to come around to the concept of ETFs, is that it's far more complicated than that. When you buy an ETF, you're not actually buying a portfolio of securities.
Buying things that look like those securities.
Exactly. You're buying promises.
It's a little tricky. But you're getting it. I mean, if you went to Vanguard and you had to decide between the two, I bet the Vanguard 500 ETF is less expensive than the mutual fund, even though they're both relatively inexpensive. The ETF, remember, trades during the day. Mutual funds only trade once. So this is one of my problems with ETFs, is it creates this desire to say, oh, the market's way down. And even John Bogle didn't like them for that reason. So, but if I was just starting out and I was going to go ahead and buy one, I probably would say just get the exchange traded fund. What's the price differential, Don?
Oh, I don't know. I'd have to look them up.
I thought you were looking at that.
No, okay, what I was looking at is I'm trying, because ETFs are really hard to understand. They are a basket of securities that market makers have pledged. People who have all these stocks, they've pledged them. But you don't actually, when you buy an ETF, you don't actually have the stocks. When you buy and sell ETFs, then they liquidate this basket and move money around. It's more convoluted, and that's, again, why it took us so long, because I like simple. And mutual funds are simple. They're straightforward. But ETFs, particularly index-based ETFs, are pretty darn safe.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics, that's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Your guides to a really great financial future. Tom and Don are talking real money.
And a lot of people don't know that in addition to doing this show, we also, about 10 years ago, started an investment advice firm based on the things we've done on the radio for years. And it's called Vestory, and we believe in helping everyone get off to the right start and enjoy a better future, even if you never become a client. And we don't pressure you to become a client. There's no high pressure sales pitch, but we do help everyone. So if you'd like to get a little help, you can set up an appointment so easily by going to vestory.com and spending some time with one of our fiduciary advisors. They won't try to sell you anything. There's no obligation, and there's no cost if you keep it under like an hour or so. So go to vestory.com and set up an appointment.
That the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.